But we also see, I mean, we know that China has been buying gold, and effectively what they're doing is they're selling dollars. I mean, we think of them in terms of buying gold, but actually what they're doing is getting rid of dollars. This is actually beginning to work rather against the dollar. And the interesting thing is that you've got to look at this in terms of how the US government is going to finance its budget deficit. We know that the Chinese are not interested in increasing their interest in US treasuries. And what this move in gold is telling us is that they're actually selling dollars, actively selling dollars. So they will probably be selling US treasuries as well.
While everyone is surprised by gold's recent surge, reaching record highs this week and extending a remarkable March rally, legendary investor Alasdair Macleod raises a significant concern. He notes a conspicuous absence of interest from Western buyers, indicating that traditional markets do not drive the recent surge in gold prices. Much of this lack of interest stems from central banks, which have been on a gold buying spree. In 2022 and 2023, central banks bought over 1,000 tons of gold, more than double their net purchases in 2021, according to the World Gold Council. The People's Bank of China led the way last year, accounting for over 20% of central bank net purchases. China's gold consumption rose to 630 tons in 2023, surpassing India's, which saw its consumption reduced to 562.3 tons. Despite previous knowledge of China and India's gold buying activities, Alasdair notes that this recent influx of demand has left the market short of physical bullion liquidity. This surge in buying, primarily focused on gold rather than silver, indicates a concerted effort by major Asian players to divest from fiat currencies, notably the US dollar. While China's purchases are often viewed as acquisitions of gold, they effectively signify a selling off of dollars. This trend extends beyond gold, as evidenced by China's accumulation of copper, further challenging the dollar's dominance. Alasdair underscores the implications of these actions for the US government's financing of its budget deficit. With Chinese disinterest in increasing their holdings of US treasuries and Japan's efforts to support its currency, Alasdair sees a dwindling pool of buyers for US debt. This raises concerns about who will absorb the increasing debt issuance, especially considering the substantial increase in debt within a short time frame. We will present clips from Alasdair Macleod's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I mean, first of all, I think the big question is who's buying it. It's nobody in the West, that's for sure. Interestingly, for the last 3 trading sessions, including today, gold has risen strongly on the London morning fix, which happens at about 10:30 our time. So what this indicates to me is that you've got Far Eastern and Middle Eastern interest goes into the hands of the banks, and the banks then cover themselves on the fix as part of that process. So this is interesting because it really does indicate that even though we know that China and India and so on and so forth have been buying gold and effectively left the market really very short of liquidity, physical bullion liquidity. This is the first time we've actually seen them aggressively come into the market and buy on the fix through their agent banks. So this is, I think, something we ought to note. And it's interesting also that this is specifically gold. Silver has been left behind in this. Silver, I don't know what the gold-silver ratio is. If you just, I'll just have a quick look. Yeah, you see it's up to 90. I mean, it's crazy. So this is not a silver game at all. It is purely gold. Now, what that tells me is that there are some very, very big Asian interests looking at the dollar, looking at fiat currencies, and basically wanting to get rid of fiat currencies for gold in this case. But we also see, I mean, we know that China has been buying gold, and effectively what they're doing is they're selling dollars. I mean, we think of them in terms of buying gold, but actually what they're doing is getting rid of dollars. And it's not just gold. The Chinese have been stockpiling copper, What does that involve? That means getting rid of dollars, in this case for copper. So this is actually beginning to work rather against the dollar. You've got to look at this in terms of how the US government is going to finance its budget deficit. We know that the Chinese are not interested in increasing their interest in US treasuries. And what this move in gold is telling us is that they're actually selling dollars, actively selling dollars. So they will probably be selling US treasuries as well. The amount of debt famously is increased by $1 trillion in 100 days. Now, that rather implies that you've got an increase in debt of over $3 trillion in any one financial year, and that assumes no further acceleration from here. So, but who's going to buy it? I mean, basically, the US Treasury has absorbed the liquidity in the system through issuing T-bills, but they haven't really tested demand out along the yield curve. How difficult it will be for the US government to fund itself, I think that's becoming apparent. And this sort of flight out of gold is being reflected in dollars. We also see it in virtually every other currency. To some extent, that's probably a mechanical thing because other currencies haven't really risen against the dollar. So, and it makes me wonder slightly whether there's some serious thinkers in Asia, and I would include in the Middle East in this one, incidentally, who are sort of looking at the dollar and thinking, this is no longer where we should have our foreign interests in, this is now becoming too much of a liability. We ought to reduce our exposure to dollars.
As Federal Reserve Chair Jay Powell and other central bank officials consider cutting interest rates later this year, there's a lot to chew on. If the Federal Reserve were coerced into cutting interest rates, perhaps due to prior commitments, Alasdair believes that any resulting improvement in the bond market would likely be short-lived. In fact, he doesn't foresee such a scenario unfolding at all. If the Fed opts for rate cuts, it would be a reactive measure to mitigate a looming financial catastrophe. The ramifications of this, according to Alasdair, are profound. All financial assets tied to bond yields, particularly Treasury bond yields, are poised for a significant downturn. Given the US government's staggering budget deficit, estimated to be around 12% of GDP, coupled with an overall government debt-to-GDP ratio exceeding 120%, he believes the nation is ensnared in a debt trap. There seems to be no viable escape route for the US government. Even if the Federal Reserve were to reintroduce quantitative easing, as some hope, Alasdair thinks it would only further undermine the dollar. Alasdair argues that the Federal Reserve's options are limited, and the US government faces dire fiscal challenges. Even the possibility of quantitative easing seems unlikely to provide a sustainable solution. As the nation grapples with its mounting debt burden, investors are left to ponder the long-term implications for the economy and financial markets. Let's get back to the interview.
I think it's that hope which means that the yield on the 10-year, for example, is hovering around about 4.2%. Basically, there is too much inflation in the pipeline for any cut in interest rates to stick. The implication, if you like, of a budget deficit in this fiscal year, which will run close to $3 trillion, and I think it could be $3.5 trillion, is that there is a lot of inflationary pressure in the pipeline, purely from the monetary point of view. And that is before foreigners in particular take an objective view, a subjective view of the dollar on the foreign exchanges. So it's a situation where, there may be, if the Fed is forced into a cut in interest rates for some reason, like they've said they would do it, so they better do it. And it's about as weak as that. Then there may be a temporary improvement, if you like, in the situation as far as bonds are concerned, but it will not last long. And I actually don't really see it happening in the first place. If the Fed feels that it has to cut interest rates, it will be because it is forced to try and rescue government finances from a catastrophe. Now, that they will fail in doing it because, really what matters is you've got to ask yourself, who is going to buy the debt? And if nobody's going to buy the debt at anything like these interest rate levels or bond yield levels, then the yields have to rise, and they have to rise to the point where foreigners will buy it. And I think that's a lot higher than the current level. So, but the implications for that are that all financial assets which take their value from bond yields, treasury bond yields in particular, are going to crash. There is no other conclusion that one can draw from this situation of the US government effectively running something like a 12% budget debt to GDP. I mean, this is a very dangerous situation, and this is on top of an overall level of government debt to GDP in the region of 120%. I mean, they are in a debt trap. And there is absolutely no escape for the US government. I suppose that the Fed might bring back QE. That's what a lot of people hope. But that just destroys the dollar. And so you can see that anyone rationally sitting down, any foreigner who hasn't got a sort of, let's say, a gung-ho feeling for the dollar, but actually has to be pretty sensible about dollars which are not their currency. They're going to look at this and they think, this is not something I want to be part of. And I don't care whether the markets are wrong or right or whatever. I mean, why should I hold debt with a government which, first of all, is running this huge budget deficit, has a debt to GDP level of over 120%, and weaponizes its currency? It could weaponize it against me. Do I want this? This is not something I want. I'm getting out, And I think that's really the problem which the US Treasury finds itself.
The recent surge in gold prices, fueled by increased interest from Far Eastern and Middle Eastern markets, suggests a fundamental shift in the gold trading landscape. This trend is likely to continue as major Asian players seek to diversify away from fiat currencies, particularly the US dollar. As a result, we can expect gold prices to remain elevated in the foreseeable future, reflecting ongoing efforts to reduce reliance on traditional Western markets. Share your thoughts on Alasdair's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.